As of Friday, May 1st, 2026, the market officially closed for the week with Supermicro Computer Inc. trading under the ticker SMCI, ending the session at $279, representing a daily decline of approximately 1.09%. While the closing figure itself may initially appear relatively routine, the broader intraday movement told a far more consequential story about the current state of investor sentiment surrounding the company. During the session, SMCI advanced to an intraday high of 28.30, briefly suggesting the possibility of a technical breakout and renewed bullish momentum before sellers regained control and forced the stock sharply lower toward its intraday low of 26.87. That type of wide trading range in a single session reflects the elevated uncertainty that continues to define SMCI's market behavior. Investors are no longer treating Supermicro as a straightforward artificial intelligence growth story. Instead, the stock has become a battleground between those focused on extraordinary revenue expansion and those increasingly concerned about deteriorating profitability, capital intensity, and the sustainability of the company's operating model. The result is a stock that remains highly volatile despite operating in one of the strongest secular growth themes in the market. At the center of the investment debate is the company's upcoming earnings report scheduled for May 5th, which many investors view as one of the most important quarterly updates in Supermicro's public history. Consensus expectations continue to focus heavily on the company's ability to meet or exceed the widely watched $12.4 billion revenue target. However, while revenue will undoubtedly attract headlines, the far more important variable may be what happens beneath the surface of the income statement, specifically gross margins. In the prior quarter, Supermicro reported a dramatic compression in gross margins to just 6.3%, a level that shocked many market participants and represented a sharp departure from the double-digit margin profile investors had historically associated with the company. That collapse forced the market to reassess whether SMCI's extraordinary revenue growth was being achieved at the expense of long-term profitability. If margins fail to recover meaningfully in the upcoming report, investors may conclude that the business is transitioning from a premium infrastructure provider into a lower-margin hardware assembler, fundamentally changing the valuation framework applied to the stock. This creates a highly unusual setup in which the company could post record revenue and still experience a material sell-off if profitability metrics disappoint. The margin issue is not occurring in a vacuum. It reflects mounting structural pressures inside Supermicro's operating environment. One of the largest contributors to recent margin compression has been the rapid adoption of direct liquid cooling infrastructure, which is becoming essential for next-generation AI server deployments. While this technology is strategically necessary in order to support increasingly power-dense chip architectures such as NVIDIA's Blackwell platform, it also introduces significantly higher manufacturing complexity, component costs, and deployment expenses. At the same time, competition has intensified materially. Legacy enterprise hardware giants such as Dell and Hewlett-Packard Enterprise have accelerated their own AI infrastructure offerings, eroding what was once Supermicro's key advantage in speed and customization. As a result, the company may be increasingly forced to compete on price rather than differentiation. And if that dynamic persists, margin pressure may remain a structural feature of the business rather than a temporary issue. This is the core concern now driving institutional caution. Whether Supermicro can maintain its dominant growth profile without permanently sacrificing profitability. Within the broader artificial intelligence ecosystem, Supermicro occupies a strategically important but increasingly scrutinized position. Companies such as NVIDIA continue to capture investor enthusiasm because they control the intellectual property underpinning the AI revolution. Supermicro, by contrast, serves as the physical infrastructure enabler, the company responsible for building the server racks, thermal management systems, and modular hardware platforms necessary to deploy those AI chips at scale. For much of the early AI infrastructure build-out, this positioning allowed investors to treat SMCI as a leveraged play on data center expansion. However, the market is now drawing a sharper distinction between IP owners and hardware integrators. The question is no longer whether Supermicro can build the infrastructure required for AI deployment. The question is whether it can do so while generating returns that justify a premium valuation. This subtle but important shift in investor psychology helps explain why the stock has lagged, even during periods when broader AI-related equities remain strong. Trading activity further supports the idea that larger investors are approaching the name with caution. While recent volume patterns indicate sustained institutional participation, the nature of that participation appears more defensive than opportunistic. Rather than aggressive accumulation, current flows suggest hedging behavior and event-driven positioning ahead of the May 5th earnings release. Institutional investors appear unwilling to materially increase exposure until management demonstrates that margin compression, cash burn, and working capital pressures are temporary rather than structural. In contrast, many retail traders have attempted to accumulate shares near the stock's 52-week low of 19,948, viewing the pullback as an attractive entry point relative to the highs reached during peak AI enthusiasm. Yet technically, the stock remains trapped in a medium-term falling trend channel, and until it can produce a sustained breakout above the critical $20 resistance zone, the prevailing chart structure continues to favor sideways consolidation or additional downside rather than immediate recovery. Relative performance metrics reinforce this cautious interpretation. Despite operating in the center of the AI infrastructure narrative, SMCI has materially underperformed the broader technology hardware sector and the general equity market over the past year. More than 80% of stocks in the broader market have delivered stronger performance during that period, a striking statistic for a company supposedly positioned at the heart of one of the most powerful secular growth themes in modern markets. Such underperformance suggests that investors increasingly believe the market may have overestimated the economic quality of Supermicro's business model. While demand for AI servers remains robust and likely durable over the long term, the contrarian argument gaining traction is that AI hardware infrastructure may be commoditizing faster than expected. If server integrators become interchangeable suppliers competing primarily on price, then valuation multiples across the sector may continue compressing regardless of revenue growth. From an operational perspective, Supermicro's rapid expansion is introducing additional execution risks. The company recently outlined plans to scale production capacity to approximately 6,000 racks per month, with a substantial portion of that expansion dedicated to direct liquid cooling systems. Strategically, this capacity build-out is designed to position the company at the forefront of next-generation AI infrastructure deployment. However, scaling manufacturing at that pace has created notable operational strain. Inventory balances have increased, working capital requirements have expanded, and the company's cash conversion cycle has lengthened as it purchases components and incurs labor costs well in advance of customer payment collection. In practical terms, Supermicro is increasingly financing its own growth upfront, creating pressure on cash flow even as revenue expands rapidly. This dynamic is why the cash flow statement in the upcoming earnings report may prove as important, or potentially more important, than headline EPS figures. Investors want confirmation not merely that the company is booking orders, but that it is converting those orders into cash efficiently and sustainably. Another underappreciated risk within the investment thesis is customer concentration. A meaningful share of Supermicro's revenue is derived from a relatively small number of hyperscale and enterprise data center clients. This concentration creates substantial dependency risk. Should even one major customer choose to diversify suppliers, shift procurement toward internal hardware solutions, or renegotiate pricing aggressively, the financial impact on Supermicro could be severe. This reality introduces an inherent fragility to the company's revenue base that contrasts sharply with the market's often simplistic narrative of uninterrupted AI-driven expansion. Strong secular demand does not eliminate customer concentration risk, and in hardware businesses, reliance on a limited number of large contracts can create significant earnings volatility. Technically, the stock remains in a vulnerable position despite some early signs of stabilization. Momentum indicators such as the RSI have begun to trend modestly higher, suggesting that selling pressure may be easing at the margin. However, price remains firmly below both the 50-day and 200-day moving averages, confirming that the broader technical trend remains bearish until proven otherwise. A sustained move above $29 would represent the first meaningful sign that buyers are regaining control, while the more important medium-term breakout level sits near $36. Conversely, if the May 5th earnings release disappoints, particularly on margins or cash flow, the stock could quickly revisit the $20 support zone, where prior buyers last emerged in size. Given the stock's elevated average true range, such a move would not be unusual under current volatility conditions. Looking further ahead, Supermicro still possesses legitimate long-term opportunities if execution improves. The company remains well-positioned to benefit from continued deployment of NVIDIA's Blackwell GPU platform, which is expected to drive substantial AI infrastructure demand into 2027. Its early investment in liquid cooling architecture may yet provide a competitive advantage if management can scale operations efficiently and restore profitability. However, those future opportunities remain contingent on successful execution in the present. The market is no longer willing to assign a premium valuation based solely on revenue growth and AI exposure. Financial discipline, margin recovery, and cash generation have become the decisive variables. In summary, Supermicro remains one of the most debated and polarizing names in the technology sector. The company sits at the intersection of extraordinary secular demand and growing operational skepticism. It continues to benefit from one of the strongest growth backdrops in the global market, yet investors are increasingly focused on whether that growth can translate into durable economic value. The stock's close at $279 on May 1st reflects more than just a market price. It reflects the ongoing tension between belief in the AI infrastructure boom and concern over the economics of supplying that boom. As the May 5th earnings report approaches, the key metrics to watch are no longer simply revenue or EPS. The true determinants of the stock's next move will be gross margins, cash flow conversion, and management's ability to demonstrate that current profitability pressures are temporary rather than structural. In a market where narrative often moves faster than fundamentals, the upcoming report will serve as a critical reality check. For investors and traders alike, the focus must remain on the numbers beneath the headlines, because in a stock as volatile as SMCI, the difference between market expectation and financial reality is where both the greatest opportunity and the greatest risk reside.